Hi there, my name's David Paradice. I have with me here Paul Mason, who works in our global small to mid-cap product, which is currently 1.3 billion. Just more as an overview, I thought I might just touch on where we see the Australian dollar, and I think it's still going to keep moving down. We are quite positive towards America. We see oil prices continuing to go down, which is going to be a huge stimulus for America. And we can see, therefore, as a result, that the American dollar will continue to be strong. So Paul, maybe you could just touch on one of the heroes from Denver, Peyton Manning, and whether you can have an analogy of that with some of the stocks in the portfolio.
Sure, David. Peyton Manning is the quarterback of the Denver Broncos, which is the #1 sporting team in Denver and has made the Super Bowl in the last couple of years, but a very iconic American quarterback, arguably the best that's played in that role. I guess the analogy being when Denver picked him up, going back 2 seasons now, he had just had a year out of the game. He had quite a bad neck injury that needed some surgery, and the Broncos took a view that he'd actually recover from that, and took the opportunity to acquire, I guess, Peyton Manning at a price where they mightn't have been able to get him if he was fully fit. So, in a similar way, we invest like that. So we look for dislocations or look for some kind of issue with a business, whether it be an unperforming segment or an acquisition that hasn't gone quite right, or maybe a big macro situation which has led to a company being cheap. It's hard to get really high quality assets with good management teams and good balance sheets at the right price, unless there's something transitory happening with that business.
So can you touch on maybe 1 or 2 stocks that are along those lines?
A really long-term compounding performer for us has been Lear Corporation, which manufactures car seats and auto electronics. We were actually screening in this situation. There were 2 dislocations. The earthquake in Japan going back 4 years now caused some disruption to the auto supply chain. And we actually started in Japan screening that, but then found our way back to the US where Lear Corporation's listed, has emerged from bankruptcy. So we've done a lot of work with companies emerging from bankruptcy. It's been quite a fertile area for us with the portfolio. So bankruptcy is very cleansing. The stocks that go in obviously have some huge issues and usually over-levered, but what comes out of bankruptcy is a very clean balance sheet, no pension liability, rationalised product suite usually, and often a new management team. So, and usually there's a lot of bad sentiment around stocks that have been bankrupt, and the market can sort of capitalise that forever. So Lear Corporation we bought going back just under 4 years now. It's more than doubled for us. Stock's over $8 billion now, so it's quite a large business.
Yeah, it's very interesting because you look at what's left in the automotive industry here, and there's nothing. It's all gone offshore.
Yeah.
And I think that's what we're finding in this particular fund, is that there are just so many investments globally to take advantage of, whereas in Australia, in some respects, unfortunately, what's happened is there's been a focus on resources, and unfortunately resources are dropping off, and therefore that's having an effect on the currency. As I said before, we can still see it moving down. So maybe you should can you just talk about some of the, maybe 1 or 2 of the other stocks that are really good quality stocks in the portfolio? I know the turnover in the portfolio is really low, and that's because you just find so many opportunities. Why should you sell something that is really good to buy something that's the same? So.
Yeah, we spend a lot of time obviously researching these stocks before we get in. So building conviction and owning these high quality assets for a long time is perfect for us. And stocks like Global Payments we've talked about, payment processing businesses, highly cash generative, high margin. Other things like we've got some quite quirky assets in there, like an Indian Bollywood film producer, but advertising business has been one of our best performers in the last 6 months, listed in the UK, M&C Saatchi, which we get great look through globally where advertising agencies do trade and what kind of margins they have. And Saatchi have done the right things, the management team's doing the right things to get margin up, and the market's starting to realise and re-rate that stock as they're doing the right things and entering new geographies, not just emerging markets which they're in, but also putting some assets on the ground in the US and tapping into the largest advertising market in the world.
Yeah, it's a really good fund in that respect also, that you can diversify away from varying sectors, and you can buy good quality stocks in one sector and a good quality stock in another sector, whereas, unfortunately in Australia, it is a small market and it is being affected by the downturn in commodity prices, as I said before, and the ripple effect of that on mining services businesses can create problems for investors such as ourselves. Thank you very much for that, Paul. It's fantastic. The portfolio seems to be in really good condition. As I said before, you know, we do believe that the global economy, especially the American economy, which drives a lot of the economy, looks as though it's in a really good position at the moment. And also the currency in Australia looks as though it's going to go down, as I said before. And given this is an unhedged product, that is very favourable for this particular fund. So thank you very much.
Thanks, David.
And look forward to another 5 years of 20% return.
That'd be nice. Thanks, David.